environment. I would now like to turn to liquidity and financial market conditions. The introduction of the standing deposit facility, that is SDF, in April this year, which raised the floor of the liquidity adjustment facility corridor, that is the LAF corridor, by 40 basis points, along with policy repo rate hikes of May and June, have effectively resulted in withdrawal of accommodation by 130 basis points. Consequently, the weighted average call rate, that is WACR, which is the operating target of monetary policy, has commensurately firmed up. At the longer end of the money market, interest rates on 91-day treasury bills, commercial papers, and certificates of deposit have also moved higher since April. The rate hikes also triggered an upward adjustment in the benchmark lending rates by the banks. Term deposit rates are also increasing, which should bode well for availability of funds with the banks in the context of sustained buoyancy in credit demand. Surplus liquidity in the banking system, as reflected in average daily absorptions under the LAF, both SDF and variable rate reverse repo auctions put together, moderated to 3.8 lakh crore rupees during June-July this year, against 6.7 lakh crore rupees during April and May. In other words, what I am saying is that thanks to the efforts taken by the RBI to undertake the SDF measure, the VRRR measures, which you are familiar with, the surplus liquidity in the banking system has come down from rupees 6.7 lakh crore in April-May to 3.8 lakh crore rupees during June-July this year. The sharp moderation in surplus liquidity from July 20th of this year, mainly on account of tax and capital outflows, resulted in money market rates firming up above the repo rate. To alleviate the liquidity stress, the RBI conducted a variable rate repo auction of rupees 50,000 crore of 3 days maturity on July 26th. Going forward, and as indicated in my statement of February 2022, the RBI will remain vigilant on the liquidity front and conduct two-way fine-tuning operations as and when warranted. And the two-way fine-tuning operations will mainly be variable rate repo operation, that is VRRR operations, and variable rate reverse repo operations, that is VRRR operations. In other words, we will do fine-tuning operations in both directions, depending on the evolving and the prevailing liquidity situation. And these will be of different tenors, depending on the evolving liquidity and the financial conditions. During the current financial year, that is till yesterday, August 4th, the US dollar, that is the index, that is the DXY, has appreciated 8% against a basket of major currencies. And I'm now talking about our financial year, that is from 1st April this year. So DXY has appreciated by 8% against a basket of major currencies. In this milieu, the Indian rupee has moved in a relatively orderly fashion, depreciating 4.7% against the US dollar during the same period, that is till yesterday. So the rupee depreciation has happened in an orderly fashion thanks to the stated policy of RBI and thanks to our steady improvement in the market to prevent volatility. So rupee depreciation has happened in an orderly fashion, and rupee has depreciated by 4.7% against US dollar till yesterday, and it has fared much better than several reserve currencies as well as many emerging market currencies as well as many of our Asian peers. And as I started reading this statement, the rupee since this morning has appreciated, and I think the depreciation, instead of being 4.7%, would be a little lower, but we have to of course wait till the end of the day, and it is a continuing process that goes on. The depreciation of the Indian rupee is more on account of the appreciation of the US dollar than weaknesses in macroeconomic fundamentals of the Indian economy. Market interventions by the RBI have helped in containing volatility and ensuring orderly movement of the rupee. We remain watchful and focused on maintaining stability of the Indian rupee. The Indian financial system, as I mentioned earlier, remains resilient. This will help the economy in emerging out of the shadows of the pandemic and the impact of the war in Europe. While the banking system remains well capitalized and profitable, a deleveraged corporate sector augurs well for sustaining the economic recovery.